Have you ever wondered what truly goes on behind the headlines when a major bank announces its quarterly results? It's rarely just about the numbers. It's usually a detailed story of strategic shifts, market adaptation, and future ambitions. Today we're asking, is Canara Bank simply riding a market wave, or are they strategically positioning themselves to genuinely outperform, build something sustainable for the future?
Yeah, that's really our mission in this deep dive. You've brought us the latest Q1 FY26 financial results from Canara Bank. Quite a stack of sources, actually. Earnings, call transcript, investor presentations. Our goal is to, well, cut through all that data, pull out the most impactful insights, and give you a crystal clear understanding of what's really happening at the bank, how they're executing their strategy, and maybe more importantly, what it implies for the broader Indian financial landscape.
Okay, let's jump right into the top line numbers then, because they are certainly striking. Canara Bank has reported some impressively robust Q1 FY26 results. Their global business grew a healthy 10.98% year on year, reaching an all-time high, their words, of 25.63 lakh crore.
Pretty solid growth there.
And what's particularly noteworthy is that global advances grew by 12.42% and deposits by 9.92%. That actually exceeded the bank's own guidance.
Right, beating expectations is always a good sign.
And here's the figure that always catches the eye. Their net profit soared by 21.69% year on year to 4,752 crore. And operating profit grew 12.32% to 8,554 crore, a result management proudly highlighted as, again, an all-time high in the history of Canara Bank.
Wow. Okay, so big numbers. But what's fascinating here is how they're achieving that growth. It points directly to their strategic focus. The primary driving force, it seems, has been their RAM portfolio. RAM stands for Retail, Agriculture, and MSME Credit.
Right, the RAM focus.
Exactly. That segment saw nearly 15% year-on-year growth, reaching 6.30 lakh crore. But here's the key insight, I think. It now constitutes 58% of the bank's total asset book.
58%. Wasn't that their long-term target?
Precisely. This isn't just hitting a number. For them to reach that 58% goal so far ahead of schedule. Remember, that was an ambitious 3-year target. It tells you this bank isn't just chasing growth. They're executing a very precise, maybe even accelerated pivot into these potentially higher yield segments.
Interesting. So hitting it early frees them up.
Yeah, likely frees up capital and strategic focus for other initiatives much sooner than they probably anticipated.
That accelerated pivot is really evident when we drill down into the retail lending boom. Retail credit alone jumped a significant 33.92% year on year. That's huge, reaching 2.35 lakh crore.
Very strong.
Within that, housing loans grew almost 14%. 13.92% to 1.09 lakh crore, and vehicle loans even faster, 22.09% to over 21,000 crore. Even their corporate credit saw a decent 10% growth. But, in such a competitive market, how sustainable is that kind of retail growth? Are there underlying factors specific to Canara Bank letting them grab so much market share?
Well, the sustainability likely comes from their diversified approach within retail, and importantly, their ability to leverage their really widespread network. The sources highlight strong demand for both housing and vehicle loans, which are, relatively stable segments. What's also crucial, beyond just the commercial success, is that the bank explicitly stated it exceeded the mandated norms in all key priority sector categories.
The priority sector lending.
Exactly. Total priority hit 45.63% against the 40% norm. Agriculture was 23.25% against 18%. Small and marginal farmers, 16.57% against the 10% norm. So this commitment doesn't just tick regulatory boxes. It often opens up new customer segments and business opportunities, which kind of reinforces the long-term sustainability of their growth.
Right. Okay. So growth is clearly a strong point. Let's maybe pivot to what's been a challenge for many banks this quarter. Net interest margins, or NIM. Canada Bank's NIM saw a decline, down to 2.55% in Q1. This is a common pressure point right now. What were the main reasons for this dip for Canada Bank specifically?
Yeah, the management pointed to a couple of things. A major one was the transmission of repo-linked lending rate reductions, the RLR.
Okay, the repo rate impact.
Right. So Canada Bank passed on 100 basis points in these RLR reductions to about 45% of their loan book. That obviously impacts the yield side. Now, they did manage to control the cost of deposits pretty well in Q4 FY25, partly thanks to significant staff contributions, actually about 16,700 crore.
Staff contributions, interesting.
Yeah, but they deliberately held off on reducing retail term deposit rates until June 8th.
Okay. Why the delay?
It was a strategic move, according to them, to garner more deposits first, to support that really strong credit growth we just talked about, even if it meant a temporary squeeze on margins.
I see. So they prioritize growth funding over immediate margin protection.
Seems like it. So the full benefit of those recent 50 to 60 basis point cuts they eventually made on term deposits, that will only really show up in the subsequent quarters, Q2 onwards.
Okay. So what's their outlook on NIM going forward then?
Well, they're cautiously optimistic, I'd say. They don't expect it to fall below 2.5%. They anticipate a not much steep reduction in Q2 compared to Q1.
So leveling off, maybe?
Sort of. But they have had to revise their full-year FY26 NIM guidance. Originally, it was 2.75% to 2.80%.
Yeah.
This adjustment is largely because they expect, one or two more rate cuts in the broader market.
Anticipating future headwinds.
Exactly. They acknowledge it typically takes maybe a 6 to 9 months period for banks to fully absorb the burden of these rate cuts. So the impact won't fully clear for a couple more quarters.
Right. Okay, so staying on the deposit front, their K-to-IOS ratio, that's current account and savings account, the cheap funds, it dipped to 29.56%. That's below their 32% guidance. What's causing that decline, and how are they planning to address it?
Well, the decline is partly down to institutional deposits withdrawing after March, which happens. But also, the bank's overall business has been growing at that double-digit pace we mentioned. So even though individual savings deposits grew by 6%, which isn't bad, that growth was just outstripped by the faster overall business expansion. The denominator grew faster, basically.
Got it. So the ratio looks worse, even with some growth.
Precisely. Their current strategy seems to involve relying more on retail term deposits for growth, as those offer more stability, even if they cost a bit more than CASA. Management is hopeful, though, that the CASA ratio will naturally pick up again if term deposit rates continue to fall below 6%. The idea is that would encourage customers to keep more money liquid in current and savings accounts.
Okay, makes sense. While managing those MIM pressures is crucial, one area where Canara Bank really seems to shine, and it's a big win for any bank, is their asset quality. It's actually quite impressive to see the progress they've made here. The gross non-performing asset, or NPA ratio, saw a significant improvement. It declined by 145 basis points year on year to 2.69%.
Yeah, that's a solid drop.
And the net NPA ratio also improved by 61 basis points, down to just 0.63%. Plus, their provision coverage ratio, PCR, strengthened by 395 basis points to a very healthy 93.17%.
93% PCR is very strong. And what's particularly insightful here, I think, is their proactive approach to potential issues. The sources detail two major SMA2 accounts. That's Special Mention Account 2, meaning overdue 60 days. So they're on the watch list.
Right, the ones close to slipping.
Exactly. Each over 5 crore. One is a Bangalore real estate account, about 2,000 crore, and the other is a state government guaranteed irrigation project for 3,000 crore. Crucially, management expressed, and this is a direct quote, 100% confidence that these accounts will not slip to NPA.
Okay, that's bold.
It is. And as a prudent safety measure, they've proactively provided an additional 1,200 crore against these exposures anyway.
Wow. So even though they're confident, they're still putting aside extra provisions, like a double safety net.
Pretty much. It definitely highlights a very prudent, very forward-looking approach from their management.
Is that common for public sector banks, or does it signal something particular about Canara?
I'd say it highlights a particularly conservative risk management stance from Canara Bank specifically. While all banks provision this level of proactive additional provisioning for accounts they claim to be 100% confident about, well, it's a strong signal. It means they're really prioritizing balance sheet strength and stability. That's generally a positive sign for investors and the long-term health of the bank.
Definitely.
And speaking of good news on asset quality, the bank noted a recovery of 1,160 crore from written-off accounts this quarter. That goes straight to the bottom line.
Nice little boost.
Yeah, and management anticipates much better recovery in the current quarter. They mentioned 4 significant proposals totaling 1,200 crore due for repayment soon. So this proactive management of stressed assets plus the expected recoveries leads them to believe their gross and net NPA targets for March 2026 could potentially be met much earlier, maybe September or December 2025.
Getting ahead of their own targets again.
Seems to be a theme. Oh, and just quickly, there's an exceptional book entry mentioned, 1,833.03 crore in the consolidated results. That relates to the transfer of Andhra Pradesh Gramin Bank, APGP, to Union Bank. It was just a book entry at face value, not market value, which explains the difference in the consolidated numbers. Just a technical point.
Got it. Okay, so moving beyond interest income, Canara Bank really diversified its income streams this quarter. Total non-interest income grew by a strong 32.73% year-on-year to 7,060 crore.
That's a significant chunk of income.
Yeah, and it was fueled by a solid 16.39% increase in fee-based income, but also a truly remarkable, get this, 296.22% surge in treasury income. It reached 1,993 crore. What's driving such a massive jump in treasury income? That seems unusually high.
Yeah, it is a significant contributor to that non-interest income, and an area where they've shown considerable strategic acumen is from PSLCs, Priority Sector Lending Certificates.
Ah, the PSLCs again. Explain this quickly for listeners.
Sure. Basically, they're tradable certificates. Banks have mandatory targets for lending to priority sectors like agriculture, small businesses, etc. If a bank like Canara lends more than its target, it gets these certificates. They can then sell these certificates to other banks that haven't met their targets.
Okay, so it's like trading regulatory compliance credit.
Exactly. And Canara Bank earned a hefty euro 12,000 euro 2 core this quarter from selling these excess priority sector assets. Pure income. They benefited hugely because higher market demand pushed the yields, the price for these certificates, up to nearly 3%, whereas earlier it was more like 1.6, 1.7%.
So they timed the market well or just benefited from market conditions?
A bit of both, perhaps, but they were well positioned with excess lending. And importantly, even after selling 1,200 crore worth, they still maintained substantial cushions, comfortably exceeding all their priority sector targets. And management made it very clear, stating, and this is another quote, PSLC income is not stopped for this bank. It will continue not only this year, but the next year also.
Okay, so they see this as a sustainable income stream, not just a one-off windfall.
That's the message they're sending, yes. It suggests they plan to continue overachieving on priority lending to generate this income.
Interesting strategy. Okay, let's look at their strategic direction now. It's clear they're investing heavily in the future. The bank continues to allocate 1,000 crore annually in technology. That's driving an operating expense growth of about 6-8%. How critical is this tech investment to their overall strategy, especially, today?
Oh, it's absolutely critical. You can't compete without it now. And their digital transformation initiatives seem quite ambitious, spanning multiple areas. They're developing a comprehensive cybersecurity platform that's a 70 crore investment expected within a month. Essential, given the rise in digital transactions.
Definitely needed.
They've also launched a new digital product, Loan Against Mutual Fund, and they've enhanced mobile banking limits. But maybe their boldest goal is to convert 100% of their RAM portfolio, that's their big growth engine, retail, agri, MSME, 100% onto a digital lending platform by March 2026.
Wow, 100% digital for RAM. That's ambitious. Where are they now?
They said about 70-75% is already done, so they're well on their way. They're also investing over 100 crore in a completely new credit card platform, aiming for aggressive growth in that segment too.
So it's not just about efficiency, it's about enabling growth through tech.
Precisely. It's about reach, customer experience, faster processing, and ultimately capturing new market share in a digital-first world.
Right. And it's not just the tech itself, it's also about the people, right?
Right.
I see they're bringing in a significant number of IT specialists. How critical is that human element compared to just, buying the software?
It's paramount. Absolutely essential. You can have the best technology stack in the world, but without skilled people to implement it, manage it, adapt it, evolve it, it's just an expensive sum cost. The sources really highlight their focus here. They recently recruited 120 IT specialists, and they're in the process of onboarding another 60 higher cadre IT specialists.
So serious investment in skills.
Yes. It ensures they have the in-house expertise to truly leverage those tech investments, build new digital products quickly, and manage the increasingly complex cybersecurity landscape. It's a holistic approach, really. Tech and talent together.
Okay. What about their subsidiaries? Any strategic moves there?
Yes, management confirmed IPO plans for 2 subsidiaries. They were quick to assure, though, that Canara Bank will remain the leading major owner even after dilution. They're also strengthening Canara Bank Securities Limited. The idea is to better serve customers interested in equities and mutual funds, hoping for knock-on benefits for their CASA base. Synergies, basically.
And CanFin Homes. There's often speculation about that stake.
They addressed that directly. Management stated very clearly they're not thinking of any stake sale in CanFin Homes. The focus is purely on growth there, and they sounded quite confident, actually, that the share price will eventually reflect €1,000 up from its current level around 800.
Right. Bold prediction.
And finally, kind of bringing it together, they mentioned the government's push for higher growth in MSME and agriculture. Aligning with that, Canara Bank is aiming for beyond 20% growth in MSME specifically. They expect the overall RAM sector to continue growing at around 15%, and they're targeting overall credit growth at a minimum 12%. So it indicates a very clear, growth-oriented strategic vision for the coming periods.
Okay. So wrapping this up, what does this deep dive really suggest about Canara Bank's current position and maybe its future trajectory? Their Q1 results paint a picture of, well, impressive financial performance, clearly driven by strong RAM credit growth, that healthy non-interest income from strategic plays like the PSLCs, and what seems like a very proactive, maybe even conservative approach to managing asset quality. They're clearly tackling the interest rate volatility head-on while making these substantial targeted investments in digital transformation and, crucially, the human capital to make it all work.
Indeed. Which leads to a final thought, perhaps, for you listening to consider. Given Canara Bank's robust performance this quarter, especially in that RAM credit space and their non-interest income, how do you think their proactive approach, managing interest rate volatility, investing so heavily in digital, how does that position them, not just against their public sector peers, but maybe even against the private banks, in this really rapidly evolving Indian banking landscape? What does this deep dive suggest, maybe more broadly, about the future of traditional banking models in an economy that's increasingly, undeniably digitally driven? Something to think about.